a $4,200 yearly hit from the Fed's next move. The Fed's latest comments hint at higher interest rates, impacting borrowing costs and spending power. You'll learn how this affects your finances and what you can do to protect yourself. The Fed's rate hike could increase borrowing costs by $1,200 to $2,000 per year for the average American with $20,000 in credit card debt. For example, if you have a $300,000 mortgage with a variable interest rate, your monthly payments could rise by $150 to $300. This is because the prime rate, which affects variable rate loans, is expected to rise by 0.5% to 1%. Back in 2008, during the financial crisis, the Fed lowered interest rates to stimulate economic growth, but this led to a surge in borrowing and subsequent debt. Today, with the average credit card debt per household standing at around $4,700, the impact of higher interest rates will be felt even more. Consider the case of John, who has a $10,000 credit card balance with an 18% APR. If the interest rate increases by 1%, his annual interest payments could go up by $100. But what about other types of debt, like student loans or personal loans? And how can you prepare for these increased costs? For instance, you could consider consolidating your debt into a lower interest loan or balance transfer credit card. Additionally, back in the 1990s, when interest rates were higher, many consumers opted for debt consolidation loans to reduce their monthly payments. For example, Emily, who had a $5,000 personal loan with a 12% APR, was able to consolidate her debt into a lower interest loan with an 8% APR, saving her $200 per year in interest payments. We'll explore that next. Higher interest rates can reduce consumer spending power by $1,500 to $2,500 per year as people allocate more of their income towards debt payments. This can have a ripple effect on the economy, as reduced spending power leads to lower demand for goods and services. For instance, if you're used to spending $500 per month on discretionary items, you may need to cut back to $300 to accommodate higher debt payments. A common misconception is that higher interest rates only affect borrowers, but in reality, they can also impact businesses and the broader economy. Back in the early 2000s, when the Fed raised interest rates, it led to a decline in consumer spending, which in turn affected the sales of companies like Walmart and Target. Now, with the rise of online shopping, the impact of higher interest rates on consumer spending power could be even more pronounced. Consider the case of Emily, who has a $50,000 car loan with a 6% APR. If the interest rate increases by 1%, her monthly payments could go up by $25. But what about the potential benefits of higher interest rates, such as increased savings rates or reduced inflation? And how can you adjust your budget to account for these changes? For example, you could consider reducing your expenses, increasing your income, or exploring alternative investment options. Furthermore, a second-order effect of higher interest rates is the potential impact on employment rates. As businesses face increased borrowing costs, they may be less likely to hire new employees, leading to higher unemployment rates. We'll dive into that next. But the part that surprised me most is how this affects your 401k. And I'm not just talking about the obvious impact on your retirement savings. In the next section, we'll explore a little-known strategy that could help you turn the tables on the Fed's rate hike and actually grow your retirement nest egg. You'll learn how to take advantage of the changing interest rate landscape and make the most of your retirement investments. Specifically, we'll discuss how higher interest rates can lead to higher returns on certain types of investments, such as bonds and CDs, and how you can adjust your portfolio to take advantage of these changes. Higher interest rates can actually benefit retirement savers, as they can earn higher returns on their investments. For example, if you have a $100,000 401k balance, a 1% increase in interest rates could result in an additional $1,000 in annual returns. However, this also depends on the type of investments you hold and the overall market conditions. Back in the 1990s, when interest rates were higher, retirement savers enjoyed higher returns on their investments. But this also came with increased volatility. Today, with the rise of index funds and ETFs, retirement savers have more options than ever to take advantage of higher interest rates. Consider the case of Michael, who has a $200,000 401k balance invested in a mix of stocks and bonds. If the interest rate increases by 1%, his annual returns could go up by $2,000. But what about the potential risks, such as increased market volatility or reduced stock prices? And how can you adjust your investment strategy to take advantage of these changes? For instance, you could consider diversifying your portfolio, exploring alternative investments, or working with a financial advisor to create a customized retirement plan. Additionally, a common misconception is that higher interest rates only benefit savers, but in reality, they can also benefit borrowers who are able to refinance their debt at lower interest rates. We'll explore that next. Now, let's look at a historical parallel to this situation and what we can learn from it. In the next section, we'll explore the 2004 to 2006 rate hike cycle and how it affected the economy, including the housing market and consumer spending. You'll learn how to apply the lessons from history to the current situation and make informed decisions about your finances. Specifically, we'll discuss how the 2004 to 2006 rate hike cycle led to a housing market bubble and eventual crash, and how you can avoid making similar mistakes in the current market. We'll also discuss the potential risks and opportunities that come with higher interest rates, so you can stay ahead of the curve. The last time the Fed raised interest rates, from 2004 to 2006, the economy experienced a period of moderate growth, with the GDP increasing by 3.5% to 4.5% per year. However, this also led to a housing market bubble and eventual crash. What can we learn from this experience, and how can we apply those lessons to the current situation? For instance, if you're considering buying a house or investing in real estate, you may want to exercise caution and carefully evaluate the potential risks and rewards. Back in 2006, when the housing market was at its peak, many investors were caught off guard by the subsequent crash. Today, with the rise of real estate investment trusts, REITs, and crowdfunding platforms, investors have more options than ever to participate in the real estate market. Consider the case of Sarah, who invested in a REIT during the 2004 to 2006 rate hike cycle. She was able to earn a 10% annual return on her investment, but she also faced increased volatility and risk. But what about the potential benefits of higher interest rates, such as reduced inflation or increased economic competitiveness? And how can you adjust your investment strategy to account for these changes? We'll summarize the key takeaways in the conclusion. In conclusion, the Fed's rate hike could cost you $4,200 per year, but it also presents opportunities for retirement savers and those who can adjust their budgets and investment strategies accordingly. To recap, we've discussed the impact of higher interest rates on borrowing costs, consumer spending power, and retirement savings. We've also explored historical parallels and lessons from the past. Now, it's time to take action. Consider the following steps. Review your budget and adjust your expenses, explore alternative investment options, and work with a financial advisor to create a customized plan. Additionally, take a closer look at your debt and consider consolidating or refinancing to take advantage of lower interest rates. By taking control of your finances and staying informed, you can turn the tables on the Fed's rate hike and achieve your long-term financial goals. If this changed how you think about the Fed's rate hike, hit subscribe. I break down one of these every week. And as a final step, take the next 30 minutes to review your financial situation and make a plan to protect yourself from the potential impact of higher interest rates.